All right, welcome everybody. This is our quarterly economic and market outlook review for our clients, and I hope you'll have the opportunity to join us for the next, let's say, about a half hour. Before we get started, I want to just mention a little bit of compliance. We produce these materials with our best information, and it's important to recognize that as much as we believe the information to be accurate, things will change, and you should be sure to keep that in mind and contact us with any questions. When it comes to performance information, we've largely relied on Morningstar Morningstar Office as a tool to provide us details for the calculations we've done. To start off, I'm Chris Boyd. I assume most of our clients are familiar with me. I am the founder of our firm, Asset Management Resources, and the Chief Investment Officer. And I'm also joined today by Brian Regan, who is our Portfolio Manager and Economic Strategist.
Hi, Chris.
So thanks for being here, Brian. And Brian's prepared a lot of our slides, and I think you'll enjoy a lot of the material. You know, of course, that we have a team here both in our Hyannis office as well as our Dedham office. Mike Perna is our advisor in Dedham, and he's supported by his assistant, Lords. And then with the rest of our team here in Hyannis, we've had an addition, and that is Scott Birmingham, who is also a financial advisor.
Hi, Chris. Thanks for having me. Excited to be here. A little bit about myself. I'm a certified financial planner. I'm a chartered financial consultant. I've had the pleasure of working with families in the greater Boston area for about 20 years. And, I hope to be a resource to the firm and to the clients.
And Scott actually has several other academic certifications and accomplishments that are very helpful in dealing with a variety of financial planning issues. So Scott, thanks for being here. Scott's gonna be someone who will be a resource both to me and our clients. If ever you can't reach me, please do reach out to Scott as well. So with that, let's get started with our agenda today. We are planning to start off with a little bit of a review of what happened over the prior quarter, as well as some highlights of some economic data that we think is relevant to you as you think about what we might expect as we look ahead, and our take on what's happening in the economy around us, as well as a little bit of a review of what's happening both in the equity and fixed income markets. And then we'll conclude with a brief review of some of the takeaways that we think you'll likely see as things we're contemplating and likely to implement when it comes to your portfolios when they are discretionary managed portfolios. So, Brian, you want to take it from there?
Sure. So this is a review of the things that we went over last quarter in the last webinar, and we've talked to many of you in person about it, and we implemented them in most of your portfolios. We'll see at the top when we start to say global macro, what we really mean is what does the global landscape look like, particularly internationally. And in the fourth quarter, we eliminated our emerging markets exposure, and in February, for the end of February, specifically February 28th, I added it back in most of the portfolios. And we did this because we had some optimistic rhetoric from both China and the United States on the trade talks. And so far, that trade has worked out well for our investors. On the domestic side of things, we said we were going to be underweight equity versus bond in the allocation and equal weight growth value. The reality is we were underweight equity. We were a little bit tilted towards growth still because we were trying to avoid companies with poor balance sheets. We moved back towards NASDAQ 100, which is the QQQ in your portfolio ticker, where we weren't in it at all in certain strategies in Q4. and we piled back in Q1, and it's done. It's performed well year to date, so it was a good trade. On the fixed income side of things, we started a treasury position back in the summer of 2018 to try to take advantage of the yield curve. The trade's really worked out for us because the treasury has fallen rather significantly. With the treasury yields fallen significantly, so the price has gone up. So we're starting to move away from that, and we started last quarter. We're continuing this quarter. We reinvested that money into our intermediate core and our total return portfolios, which have outperformed the treasury since. We're going to maintain our underweight in credit this quarter, and we started last quarter talking about the underweight in credit. There's be more about that going forward, and we've talked about it in the past, so this should be rather the same status quo.
Some continuity in the things we're saying there. Something I wanted to point out, unfortunately, we had recorded our comments back a week or so ago, just before Brian went on a vacation. And unfortunately, we had some technical difficulties, so we're re-recording our comments. And so you'll notice the dates are as of, for some of these information, they're as of April 10th. That's the explanation as to why that date is indicated. It's actually April 22nd today, the day we're recording these comments. And where there's something materially changed, we'll try to indicate that as we go through our comments today as well.
So I want to revisit prime age workers and wage growth. Back in the second quarter of last year is when the first time I think I started bringing this up. This is really explaining the conventional Phillips curve. It's regressing the employment to population ratio for prime age adults versus the employment cost index. It's really trying to say, are people getting paid more or are more people working? And what's the relationship with that? And when we first talked about this back in Q1 of 2018, that's the original red dot there in the middle of the screen, and you can see that it's moved to the right. Basically, people are getting paid more money, and there's less people available for work. What does this mean? Well, it can mean a couple things. Generally, for Main Street workers, this is a good thing, as folks are getting paid more money. For companies, this could mean that the margins that they've been enjoying are going to get compressed going forward. And additionally, it could mean that we could have a bit more of an inflationary picture, which would lead to the Fed raising rates rather than cutting rates in the future. So these are all things that are playing into our asset allocation going forward.
Okay, so when it comes to some of the more macro, or what should I call them, geopolitical kind of concerns when it comes to political events happening around the world. As Brian mentioned earlier, we had some indications that the tariff worries seem to be diminishing in terms of their severity. It looks like we're moving towards some kind of an understanding with China. The president has indicated there's likely to be some sort of resolution to this. That was a catalyst for some activity that, Brian, did you talk about that already, or will you talk about that?
Oh, we talked about it, yeah.
So with regard to emerging markets, we did do more activity as a result of that with our foreign exposure, feeling that that would be beneficial to the prospects of that. And we think that that's likely to continue to play out. However, we're attentive to the risks there in case something changes in that possibility. So with regard to other things, we've seen some good news come as it relates to the Brexit move away from the European Union. The UK's trying to, separate from the European Union. And as it relates to this, it's been a hard time for their efforts to try to resolve how to do this effectively, and the risks are high if it doesn't get resolved if it's what they are referring to as a hard Brexit. Fortunately, this has been postponed a little bit till October 31st. Gives the Prime Minister, Theresa May, some opportunity to try to figure this out further with the help of the Parliament there to see if they can get some kind of meeting of the minds with the European Union. So hopefully that'll be resolved, but in the meantime, it gives us some running room to see how that plays out. Additionally, we look around the world, and there's been some worries about the possibility of economic slowdown. China had been more of a concern previously, and that seems to be subsiding. And now, as we look at other places in Europe, particularly in Germany, we do seem to think that there's indication of some slowing economic activity, and PMI is one indicator of this, and it does suggest that we're seeing some slowdown in Germany, particularly, and more broadly in the Eurozone, while China does seem to be stabilizing and seeing a little bit more probability that the slowdown there is subsiding and likely to not be as great a concern as it might have seemed a couple of months ago. Anything else on this, Brad?
I think you did a good job.
Okay, so why don't you take over?
So this chart on the right here is all about expectations for the S&P 500, which is really domestic large cap stocks, right? So the top part of the chart is showing a relationship between our earnings per share, where we ended on the S&P 500, and the trailing PE associated. So in 2016, we saw that we ended with a 19 PE. In 2017, we ended with a 20 PE. In 2018, we ended with an 18 PE. So what this is saying is if the market expects good future years, then we'll be valued around 18, 19 to 20 on the price to earnings index, right? So multiple. So if right now the consensus estimate is around $169. If we have a 19 PE, then we should finish around 3,200. I expect earnings to come down from there, so 3,200 would be an optimistic view. If you expect it to be a harsher 2020, we'll be looking around 2874, which is a little lower than we are as of today, where we finished at the end of last trading day at 2905. I think the bottom part of the chart is probably where we are more realistically end up. The 2019 at 5% growth would be at 19 price to earnings ratio would be 2933, which is on par where we are today. And at 17 would be, which would suggest a little hesitance in the market, we would be at 2624. I think a fair range for the S&P 500 is between 2550 and 3000, given these expectations. And what I mean by that is if it's between 2550 and 3000, I would expect us to be considered fair value. If we were below 2550, I think there would be an opportunity to buy. If we were over 3000, I think it would be an opportunity to scale back a little bit.
So just to be clear, if you're not clear what we're referring to, this is the price of the S&P 500 and the expectations we have. Therefore, if, Brian, we're somewhere around 2,900, give or take, on the price of the S&P 500 index, that would imply that it's on the higher end of your expectations of where you think fair value might be.
That's correct.
And therefore, it's not to say that we expect any immediate problems, just that we don't see it going up drastically from here. If it does continue to go up, it will mean an expansion of the multiple, and that would imply that the markets are more bullish than you think may be justified at this time.
Right.
Okay, so, all right, fair enough. Continue on?
Yep.
Okay.
So this is really hammering the point home on fair value. The chart on the right is the price-to-earnings ratio for the S&P 500 over a 25-year average, and the 25-year average is 16.2. The price-to-earnings ratio for the S&P 500 today is around 16.4, basically saying exactly the same thing that we were saying on the last slide, that we're in a fair value kind of place, and without any, real changes, we should expect to be neutral. And here's the chart, closer look. It's a little small on the previous page, but it's an important chart, so we blew it up.
Okay, so that's good to know. So we're kind of near what seems like a long-term average as well.
Average, yep.
So it wouldn't suggest there's any expectation of anything drastic,
right?
Either way.
So I wanted to revisit this chart because about 6 months ago we added a healthcare ETF as part of a stabilizer for the late part of the cycle. So these charts from Fidelity show that healthcare is supposed to, or historically has outperformed during the late part of the cycle and during a recession. So right now we believe that we're in the late part of the cycle, and we want to show that the trade has done as expected. It has dulled the volatility of the portfolio. While the general market fell 21% in Q4, healthcare only fell 15%. And over the last 6 months, it's outperformed the MSCI, which is the global stock market, by about 13%. So the trade's worked out even as healthcare in recent days has been under pressure a little bit. So now we're on the fixed income here, and a big part of the news cycle over the last quarter has been talking about the inverted yield curve, which Chris will elaborate on further. But in March, we did have an inversion of the 10-year and the 3-month. Generally speaking, this is a bearish signal in the market. And the bottom left chart is something that we've talked about at length, but it's the measure of credit spreads in the market. So this is how much additional investors are expecting to get paid for their investment in lower quality companies. And when that blue line's high, that means that there's opportunity in the market. When the blue line's low, that means that the high yield market is a little expensive. So Chris has been overweight for a good part of that cycle there, that following that long red line. And more recently, we've scaled it back because the risk and reward really isn't there. We'd probably be more interested in getting in around 7% on the spreads, where right now, as of today, it's under 4%.
Okay, but there are ways in which we have some representation in the what we would maybe refer to as credit markets, but in maybe a little safer type of investment.
We own things like bank loans, which are moving up in the capital structure, but also getting paid on some credit coupons.
So when it comes to talking about the yield curve inversion, this kind of makes sense when you think about the notion that when you think about how yields should work, the longer the commitment I'm going to invest my money, you'd expect I'd get paid more for that. If I'm going to be invested for 10 years, I'd expect to get paid more than if I'm invested for 2 years. And when the yield curve inverts, that's not the case. It suggests that people are a little bit concerned about what the long-term picture looks like. And so what we've seen as recently is that there's been this inversion of the yield curve, particularly with shorter-term bonds, or somewhere in the middle of the 7-year and the 3-year, I think, treasuries. But when it comes to the 10 and the 2, we have seen a brief inversion, but that's generally the one to watch. This is a nice slide we found from State Street Investors, and it shows a couple of things here that's kind of interesting. Oftentimes people may be aware, they've heard the notion that we should watch the yield curve as an indicator for the possibilities of a future recession on the horizon, and that bears with it like the likelihood of market risk. In this slide, it shows that over the last 30 years or so, the occasions when we've seen a yield curve inversion, and how many months before it actually took before we actually were into a recession. And it tends to be anywhere from 10 months to 2 years as to how much lead time that indicator can provide a signal. And so a lot can happen in that period of time. And as you see in the next column, it shows that in many of those instances, there's still a lot of market upside before we start to see some impact on market performance. So the bottom line for us is we recognize that this is an indicator that we want to pay attention to. At the same time, it does not mean that it necessitates immediate action, and we're attentive to that and watching for many of the things And Brian, you wanted to make an additional comment about causation versus correlation.
Yeah, I just think this people point to the yield curve inversion as an indicator that there's going to be a recession, but it's really the kind of the opposite, right? What the yield curve is doing is pricing in risks into the market. So the risks are what causes a recession, not necessarily the yield curve inversion.
And it's now the bond market's reaction to some of those risks.
Right. And now if the risks go away, then there's less likely that you'll have
that actual recession,
right,
or it could extend it further out.
Right. And what we're seeing with the Brexit risk that we talked about is that literally got pushed 7 months down the road. So, like you said, it's going to naturally extend it.
Yeah, and just to a point, it is worth identifying that I think come June we'll have the longest economic expansion on record, and if a recession is identified as 2 consecutive quarters of negative economic growth, typically the way people think about how to identify a recession, we're actually going to hit that milestone then as a matter of necessity because we are within 2 quarters of June. So worth pointing that out. All right. Anything else on this page, Brian?
Nope. So here's really the wrap-up page on what we're going to do in the portfolios for Q2. I think there's going to be less changes because in the domestic stocks, for example, we are happy with the fair value of the market right now, and I don't think there's a lot of need for some immediate changes. When it comes to international stocks, we've gone to move to increase our emerging markets exposure, and we're going to maintain that going forward. So that's a new change from our takeaways in Q1 since we only made that change in February. For fixed income, we're going to continue to have our underweight in credit until we are given a good opportunity to move in there. And when we do finally make that trade, I think it's going to be a multi-year benefit for our clients. I think patience is more important here than chasing the yield, if you will, that you might get, the nominal additional yield you might get from moving into credit. From our intermediate space, we're going to discontinue our treasury allocation. We made our money there. It was a good trade, and now we're going to move shorter on the curve. Simply, we're getting, because of the yield curve inversion, we're going to get paid to take less risk. So why not do it? We're going to decrease our core intermediate allocation for the same reason, and general salary on corporate credit, and we're going to increase our short fund, which we really like in the USA.
And that gives us an opportunity to keep some powder dry when their opportunities arise. And it's really just an attempt to be opportunistic as we look forward to when we think opportunity may be more attractive. Do you want to mention anything about your Fed expectations and how that may differ from the market?
So the Fed turned really dovish in Q1, and that was surprising to the market, and the stock market rallied. In the bond market rallied as well because they were pricing in some Fed rate hikes, and now they're expecting them not to happen. I think it's more likely than not that we'll have at least one by the end of the year, one rate hike, and that's consistent with what we're seeing get priced into the yield curve over the last couple of weeks. It's been a bit of a recovery in yields, so not a recovery in price. So I think when we went over, that's one of the reasons why we go over the wage growth expectations, because if folks are making more money, then you would expect inflationary pressures to come. And as the labor market gets tighter, you would expect a cooling effect from the Fed. So there's lots of reasons to believe that we're going to have at least one Fed hike by the end of the year.
And yet at the same time, there's a lot of moving parts. And so whether it's looking at things like PMI, whether it's looking at wage growth, whether it's looking at what your expectations might come from the Fed or various things, that's a big part of how you're spending your time these days, watching for how this shapes out. At this point in time, you could see things becoming, extending things where the economic expansion continues to look favorable for a while longer, or you could see things shaping up if the right dominoes fall in place where it could become a little more concerning.
Yeah, so it's important, I think, to talk briefly about what it's going to do to these assets if there is an unexpected rate hike, right? The short end of the curve will do well. So we're positioned in the short term part of the curve, but we'll get paid more, right?
Yeah.
The intermediate of the curve won't do as well. They might not lose what they're making up in coupon, but it won't perform as well. But they might create an opportunity to buy. So if we're selling now and there's not an opportunity, we can buy in later on.
Right.
Credit will sell off more likely than not as they get priced into the fact that
that's more correlated to stocks. So that would likely, right?
Yeah, but even on a more simpler basis, right? If the interest rate goes up, they'll have to refinance at a higher rate, makes them more risky. Stocks, their discount rate will go up, so that means, generally speaking, that stocks valuation should go down. So if the Fed raises rates and we're positioned short term, like Chris was saying, we could take advantage of all those things when and if they occur.
All right, great. Well, that's about it for our comments this time. However, if you have any questions or if you're curious how this might fit into your portfolios, if it's been a while since you come in to see us, we'd be happy to have you come in and schedule a meeting. I would point out that if you have discretionary portfolios, these are the themes that are going to be working into your portfolios that we're actively doing on your behalf. If you have a non-discretionary portfolio and you haven't had a conversation with us recently, it's probably an important time to start planning to do that. We're trying to make sure that we're reaching out to everyone as well, but feel free to give us a call if you have any questions that you want to discuss how this might influence what we think should be done with your portfolio. With that, if you would like to reach us, please call us at the office at 508-771-8900. And with that, any final comments?
Thanks.
All right.
Thanks, everybody.
Thanks, everybody. We'll do this again next quarter. In the meantime, call us or check out the radio show if you have any. In the meantime, we'll be commenting about markets frequently there as well.